Bank investing often feels like a maze, filled with complex numbers and specialized terms. Many people look at bank financial statements and feel lost, unsure what matters and what doesn't. It can seem like a secret world only a few understand, but this complexity can be decoded. This guide provides a map to navigate the world of bank investments. It breaks down the essential tools and ideas you need to move from confusion to confidence, helping you understand how to evaluate banks and make smarter decisions about your financial future. Your map for this journey starts with the bank's financial statements. Think of these as the bank's DNA. Two of the most important metrics for understanding profitability are the return on assets (ROA) and the return on equity (ROA), which is the bank's net income divided by its average assets. Shows how well the bank uses what it owns to make money. ROA, which is net income divided by average equity, shows how well it uses shareholder money. ROA is like the bank's overall muscle, while ROA is the efficiency of that muscle. These two numbers are your North Star for judging a bank's basic health. Profitability is just one piece. You must also look at the quality of the bank's assets. A key item to check is the level of non-performing assets (PANs). These are loans that are not being paid back. A high level of PANs is a major red flag, showing the bank is taking on too much risk. You also need to check liquidity, or the bank's ability to meet its cash needs. A common measure is the loan-to-deposit ratio. If this ratio is too high, the bank might be over-leveraged and lending out too much. If it's too low, it's inefficient and not using its deposits well. Finally, look at growth. Fast growth might look good, but it can be a double-edged sword. You want to see sustainable, healthy growth that is in line with other similar banks, not reckless expansion. Once you understand the basics, it's time to look deeper into the bank's loan portfolio. This is where credit analysis becomes crucial. Banks must set aside money in loan loss reserves to cover loans they expect will go bad. This is a balancing act. If a bank reserves too much, it might be hiding profits or missing out on chances to lend. If it reserves too little, it's exposed to a high risk of default. As an investor, you should look for consistency. If a bank suddenly changes how much it reserves, you need to ask why. How do you spot trouble before it happens? A few key indicators can act like a canary in a coal mine. One is the Texas ratio, which compares a bank's problem assets to the hard capital it has on hand to cover them. A high ratio is a serious warning sign. Another is net charge-offs, which is the value of loans the bank has given up on collecting. If this number is rising, the bank's credit quality is getting worse. Also, be aware of accounting changes. New rules, like the current expected credit loss cycle model, can change how a bank reports its losses, making its books look very different. So it's important to understand their impact. Banks don't operate in a vacuum. They are heavily regulated, and these rules act as a safety net. Regulators use systems like CAMELS, which stands for capital, assets management, earnings liquidity, and market sensitivity, to grade a bank's health. A strong CAMELS rating is a good sign. Banks are also required to hold a certain amount of capital to absorb unexpected losses. This is their safety cushion. Regulators also force banks to undergo stress tests. These are what-if scenarios that simulate how a bank would survive a severe economic downturn, like a housing crash or a massive change in interest rates. These tests are especially important for banks as they grow. When a bank crosses a certain asset threshold, like $10 billion, it faces mandatory stress tests and a whole new level of regulatory scrutiny. As an investor, you need to know if a bank you're watching is approaching one of these milestones and if it's prepared for the new rules. Interest rates are like the ocean's tide for the banking industry. They affect everyone. Generally, when interest rates rise, banks make more money. The interest they earn on their loans goes up faster than the interest they have to pay on deposits. When rates are very low, a bank's profitability often gets squeezed. Because of this, you must pay attention to what the Federal Reserve is doing. Their announcements about interest rate changes can signal a major shift in the environment for all bank stocks. The banking industry is always changing, and one of the biggest trends is consolidation. For decades, the number of individual banks has been shrinking. This is because mergers and acquisitions are constant. Why bigger banks can often operate more cheaply, because of economies of scale. Also, the rising cost of technology and regulatory compliance makes it very difficult for smaller banks to compete. This trend creates an opportunity for investors. Banks that are well-run but small are often prime targets for acquisition. Historically, investing in these likely takeover candidates has been a successful strategy. When a merger happens, it's important to understand the deal structure. A whole bank acquisition is different from an DFIC-assisted deal, where a healthy bank takes over a failing one with government help. But the deal itself is not the end. The real success depends on post-acquisition integration. the banks must successfully merge their technology, their company cultures, and their customer service. If they fail at this, the merger can destroy value instead of creating it. Investing in banks requires a well-rounded view. You cannot just look at one number. It's about combining all these pieces into a complete puzzle. You must understand the basic financial metrics like ROA and ROE. You have to dig into the loan portfolio to assess credit risk. You need to respect the powerful role of regulations, stress tests, and interest rates. And finally, you must see the bigger industry picture, where mergers and consolidation are constantly reshaping the landscape. By learning to read this map, you can successfully navigate the maze of bank investing and make informed, confident decisions.